The exam could ask you about admission of a new partner, because sometimes all the other partners want to stay and just add a new partner. So let's assume A, B, and C own 1/3 each of a partnership, and new partner D comes along offering to contribute to the partnership cash or maybe other assets in exchange for a partnership interest. A journal entry on the partnership books would be required to admit new partner D. The total partnership capital will change because assets are coming into the partnership, D is contributing something of value. In addition, each existing partner's ownership interest will go down. So right now each owns 1/3, but each will now own 25% if D becomes an equal partner with A, B, and C. And there's 3 ways to account for adding a new partner. There's the exact method, the bonus method, and the goodwill method. Under the exact method, the partnership figures out exactly how much cash the new partner would have to contribute so that there would be an equal exchange in relation to the capital being given to the new partner. And under the exact method, the old partner's capital accounts stay the same. So here's an example of the exact method. Assume the ABC partnership has $75,000 worth of net assets. Now assume that the partnership would like to add partner D for an exact 1/4 interest in capital. How much does partner D need to contribute to receive an exact 1/4 interest? And there's a good shortcut that I want you to use for this. If you want to know a 1/4 interest, subtract 1 from 4. 4 minus 1 equals 3. So divide the 75,000 of existing net assets by 3. And partner D needs to contribute exactly $25,000 to the new partnership to have an equal 1/4 interest. And the journal entry on the partnership books that day would be debit cash $25,000, credit D capital $25,000. Notice no other partner's capital will change under the exact method. Now look what we did. We said that D wants an exact 1/4 interest, and we want to know how much does D have to contribute in cash for that exact 1/4 interest. And the shortcut that we take is 1/4 translate to 4 minus 1, which is 3. Divide the existing partnership assets by 3, and that's the exact amount that needs to be contributed. And this 25,000 comes into the partnership and adds to the 75,000 that's already there. So a total of 100,000 of net assets are now in the partnership. And we said partner D wants to receive an exact 1/4 interest. And what's exactly 1/4 of 100,000? 25,000. So we just proved that we did it right. Let's try this. Assume GHI partnership has 180,000 worth of net assets. Now assume that the partnership would like to add partner J for an exact 1/5 interest in capital. How much does partner J need to contribute in order to receive an exact 1/5 interest? And for a 1/5 interest, we take the shortcut 5 minus 1 equals 4. The old partnership capital total of 180,000, divide that by 4. And then 45,000 is the amount that new partner J must contribute for an exact 1/5 interest. It's a nice shortcut, but you got to remember it's 1/5 translates to 5 minus 1. That equals 4, and then divide the old partnership net assets or old partnership capital by 4. Remember, the term net assets means assets minus liabilities. And what is capital? It's assets minus liabilities. So 180,000 divided by 4, 45,000 is the amount that partner J must contribute for an exact 1/5 interest. And the 45,000 contributed by J will add to the 180,000 already there, so the new total will be 225,000, and 1/5 of that is 45,000. And the journal entry on the partnership books will be debit cash and credit J capital 45,000. All right, the bonus method of admitting a new partner involves something extra, either going to the existing partners, like the new partners paying more than book value, or something extra is going to the new partner because the new partner bargained a good deal and is paying less than book value. Bonuses are always adjusted between old and new partners' capital accounts. Bonuses do not affect total partnership assets. So here's an example where the bonus goes to the existing partners. A and B share profits and losses 60-40, and have capital accounts of $60,000 and $20,000 respectively. C has agreed to invest $70,000 for a 1/3 interest in the new ABC partnership. The total capital of the resulting partnership will now be $150,000. The old AB partnership of $80,000 plus the $70,000 coming in from partner C. Now here we know we're not using the exact method because we know the amount of the investment, $70,000 they tell us, for a 1/3 interest. Therefore, the balance of C's capital account should equal 1/3 of $150,000, or C's going to have capital of $50,000, even though C's putting in how much? $70,000. And that's where the bonus comes in. C paid $70,000 but only received a $50,000 capital account, so the extra $20,000 paid by C is recorded as a bonus to the old partners and is shared according to their profit and loss ratios, which they tell us were 60-40. So the journal entry for the partnership, debit cash $70,000, and then jump down here to C capital, gets credited for how much? $50,000. And then the $20,000 difference is the bonus given to partner A and partner B. Partner A is going to get 60% of that bonus, or $12,000, and partner B is going to get 40% of that bonus, or $8,000. So when the bonus goes to the old partners capital accounts go up. How about this? Falcon and Posner are partners with capital balances of $45,000 and $25,000 respectively. They split profits and losses equally. They agree to admit Randy as a partner. After the assets of the partnership are revalued, Randy will have a 25% interest in capital and profits for an investment of $30,000. What amount should be recorded as a bonus to the original partners? And the answer is B, $5,000 bonus. The total capital of the new partnership, we start with the old partnership capital, $70,000, add Randy's $30,000 investment, and then we're up to $100,000 of total partnership capital. And since Randy's receiving a 25% interest in the partnership, his capital account will be credited with 25% of the total equity of the new partnership, or $25,000. 25% of $100,000 is $25,000, and the difference between his contribution of $30,000 and his capital account balance of $25,000 is going to be credited to the other partners as a bonus to them. So the partnership journal entry on the day Randy is admitted as a new partner looks like this. Debit cash $30,000, credit Randy capital $25,000, and the other $5,000 is split as a bonus between Falcon and Posner. Both of their capitals will increase by their profit and loss ratios, which are 50-50, since they share profits and losses equally. So Falcon goes up by $2,500 and Posner capital goes up by $2,500. And you can see here that Randy only got $25,000 in capital for a $30,000 investment, and that results in a bonus to the old partners. Now let's look at a situation where the bonus goes to the new partner. So we have A and B sharing profits and losses 60-40 and have capital accounts of $60,000 and $20,000 respectively. Now last time C invested $70,000 into the partnership, but this time C is only going to invest $28,000 rather than $70,000 and still get a 1/3 interest. What's the result this time? C is going to receive a bonus from A and B. Why? Because the 1/3 interest in the partnership would be $28,000 plus $60,000 plus $20,000, a total of $108,000 of assets divided by 3 equals $36,000 of capital is what C is going to be given for an investment of only $28,000. C pays only $28,000 this time, but gets a capital account of $36,000, and that adds up to a bonus to new partner C of $8,000, and the bonus to C will reduce the capital accounts of A and B by that $8,000 total. And the partnership will debit cash $28,000. C capital will be credited for $36,000, and now we'll need a debit adjustment. We'll reduce A capital for 60% of the $8,000 bonus, and we'll reduce B capital for 40% of the $8,000 bonus. So in this example, the new partner got the bonus by paying less than book value for that 1/3 partnership interest. Okay, Ron and Mick are partners who share profits and losses in the ratio of 6-4. That means 60% Ron, 40% Mick. On May 1st, their respective capital accounts were as follows. Ron, 60,000, Mick, 50,000. On that date, Straw was admitted as a partner with a 1/3 interest in capital and profits for an investment of $40,000. The new partnership began with total capital of $150,000. Let's check that. Well, you had Ron capital 60,000, Mick capital 50,000, and then you have Straw puts in $40,000 more. So that's a total of $150,000 of net assets. Okay, and that's what they're telling us here. The new partnership began with a total capital of $150,000. Immediately after Straw's admission, Ron's capital should be what? And the answer is C, $54,000. Ron's capital, who they're asking about, starts out at $60,000 but needs to be lowered for the bonus given to the new partner Straw. Now, how do we know Straw gets a bonus? Straw's bonus is going to be $10,000, calculated as the $50,000 capital that he's receiving less $40,000 paid. And the $10,000 bonus to Straw will reduce Ron's capital. It'll also reduce Mick's capital, but they're only asking about Ron. The $10,000 bonus to Straw reduces Ron's capital by $6,000 from $60,000 down to $54,000. And the journal entry on the books of the partnership on the day that Straw is admitted as a partner, debit cash $40,000, credit Straw capital $50,000, and that $10,000 difference is the bonus to Straw that the two old partners will have to reduce their capital by their old profit and loss ratios, which they told us is 6-4, 60% Ron, 40% Mick. So that $10,000 bonus will be absorbed 60% by Ron, which is $6,000 reduction of Ron's capital from $60,000 down to $54,000. And the question asked immediately after Straw's admission, Ron's capital should be, and the answer is $54,000, letter C. So far we've seen two methods of admitting a new partner, the exact method and the bonus method. Now the goodwill method. Goodwill is recognized based on the total value of the partnership implied by the new partner's contribution. And goodwill will always go to the old partners. So if there's goodwill to be recognized, it'll look like this. They'll tell you on the exam, and they'll say A and B share profits and losses 60-40 and have capital accounts of $60,000 and $20,000 respectively. C has agreed to invest $70,000 for a 1/3 interest in the new ABC partnership, and they'll tell us that the partnership decides to recognize goodwill. Here's how we recognize that goodwill. C pays $70,000 for the 1/3 interest in the partnership, then it's implied that the total value of the partnership is $70,000 divided by 1/3, or $210,000. But the total of all partners' capital accounts is only $150,000. 60 plus 20 plus 70. Therefore, goodwill has to be the difference between the $210,000 implied value of the partnership and the $150,000 total capital accounts. $60,000 is goodwill. What happens to that $60,000 goodwill? It gets gobbled up by the old partners. And the journal entry on the day they admit partner C, they're going to debit cash, the $70,000 that C is bringing in, and debit goodwill. That's an asset that they decided to recognize, $60,000 debit to goodwill. And then the three capital accounts. C capital gets a total of $70,000, but then the goodwill of $60,000 gets divided between A and B. They'll see their capital accounts increase. A capital will absorb 60% of that goodwill, $36,000 increase in A capital, and B capital will increase by $24,000, 40% of the $60,000 goodwill. All right, Laura and Tracy are equal partners with capital account balances of $60,000 and $90,000 respectively. They agree to admit Monk as a partner with a 1/3 interest in capital and profits for an investment of $100,000 after revaluing the assets. Goodwill to the original partners should be what? And the answer is A, $50,000. Since Monk is receiving a 1/3 interest for $100,000, the implied total capital of the partnership is $300,000. $100,000 times 3, or $100,000 divided by 1/3. Same thing. With Monk's $100,000 investment, the actual total capital of the partnership would be $250,000. Monk's 100,000 plus the 150,000 that were there between Laura and Tracy. The $50,000 difference is recorded as goodwill to the original partners in accordance with their profit and loss ratios. So the total goodwill, $50,000, look how it's going to get split. Since they were equal partners before, Laura and Tracy, they're going to share $25,000 each of that goodwill. There'll be a debit to cash of $100,000. That's the money that Monk is bringing in. Debit to goodwill on the partnership books, $50,000, separate asset being recognized. And then Monk capital, $100,000. And then Laura capital goes up by $25,000 and Tracy capital goes up by $25,000. Now, why does Monk capital be $100,000? Because they told us Monk is receiving a 1/3 interest for $100,000. That means if $100,000 is coming in and a 1/3 interest is given out, the implied total capital of the partnership is $300,000. And 1/3 of that $300,000 is $100,000, and that's Monk's capital. So Monk starts out with $100,000 in capital, 1/3 of the total $300,000 implied value, and then the $50,000 goodwill gets divided 50-50 among Laura and Tracy. Note that under the goodwill method, the amount of Monk's capital was equal to the amount of cash that Monk contributed. We didn't see that under the bonus method, because under the bonus method, the amount of cash contributed is often more or less than the capital that the partner records. But under the goodwill method, however much you contribute, that's how much capital you're going to start out with. And the exam could ask you this: when admitting a new partner into a partnership, the incoming partner's capital account equals the amount of that partner's actual contribution under which of the following methods? And if you think you know, leave me the answer in the comments section. And if you found this I-75 FAR video helpful and you want to see more videos like it because it fits your learning style, go to i75cpareview.com and get yourself on the right road. Get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a link in the description.